All right, hey, welcome to Live on Real Estate, the holiday week Christmas edition of Live on Real Estate. I am David Hall, along with somewhat of the usual cast of characters. We've narrowed the pool of the characters here. We've got Chris Pizzoli, who's looking sporty today.
Yeah, ho, ho, ho.
How you feel?
Good.
Good.
Great.
You look good. I like
Happy
the
to
whole
be here.
get up. You got the whole get up going on.
Well, yeah. Yeah, I do.
From what I understand, you took in a little Star Wars.
I did.
How was it?
Well, I don't want to spoil any,
Yeah.
anybody's future viewing. I thought it was really good, though.
I want to get
maybe
back
the best
to that.
one.
I've got some questions about that as we go along.
I have questions too.
Henry,
I'm not a Star Wars guy. Let's just put it right out there.
What do you mean,
now.
not a Star Wars guy? What's that mean?
Like,
you
I'm not.
You either in or you're out. I mean,
No, I wouldn't
I
say
feel
that.
like
But you
have to like that type of.
It was a birthday party. It was
hold
a
on, time
surprise
out.
party.
Okay. First, we got Henry Doe. Henry, how
Hey,
are
good
you?
morning.
We got Chris Foster.
Sorry.
Chris, how are you this
What's up,
morning?
guys?
Okay. Let's just start off with the Star Wars thing then,
Yeah.
just real quick. When you're of the age that Chris and I are, when we were
Yeah,
10 older,
You're right.
Aged.
in our mid to late 40s, when we were 10 years old, Star Wars was the thing. It
Big.
was Luke Skywalker
Yeah.
and Darth Vader. It was the first movie, and
Right.
I don't know who wouldn't like that movie. That movie
Correct.
was awesome.
Yes.
So when you say you're not a Star Wars guy, I don't know what that means, because just by the fact that I went to that movie probably 12 or 14 times when I was 10 years old, does that make me a Star Wars guy? Because I didn't really like a lot of them after that.
That's
as much
what
as that
more
one.
what I was getting
Okay,
at. You know,
gotcha.
there's like a new generation of Star Wars. You know, this whole like we're gonna
Animated.
go back and we're gonna redo the ones at the beginning, and then they're carrying on the story. Now it's owned by Disney, and they're
Right.
gonna like keep going on and on and on about it.
This is
I
how
feel
little
about
I
it.
know about Star Wars.
Yeah.
If you could like bring a Star Wars person and a Star Trek, I might not be able to
Well,
decide.
no,
which
no,
one.
yes,
right,
you do.
yeah, you
Luke,
would,
no,
I don't know.
you
Wait,
would,
wait.
you would,
Luke
you would.
Skywalker and Darth Vader. That is Star Wars. Princess Leia, Chewbacca,
Never seen any
Han
of them.
Solo. What?
Oh, that's a
R2D2.
sin.
Zero.
Oh boy.
That's a sin. Anywho,
So what? I don't understand what they're doing though with the whole Star Wars thing. Are they redoing it? Is that what they're doing?
no, they've carried on. Like George Lucas, who wrote the Star
Yeah,
Wars
yeah,
stuff, apparently
yeah.
wrote 9 of them originally. The first 3 that you saw were actually episodes 4, 5, and 6.
So that was Star Wars, Empire Strikes Back, and
Correct.
Return of the Jedi.
Correct. But so then they decided they're going to go back, and they did 1, 2, and 3, and then they've done what 7, 8, and 9. This was 9 that just came out.
And then like the next one is going to be happening. It actually happened before.
So is Luke
4.
Skywalker still
Like a
alive
mega
in
problem.
9?
Pardon?
Is he still alive in 9, Luke?
No,
Oh, he's not there.
but he does make a cameo.
How if he's not alive?
Not going to give it away.
All right. Live on Real Estate, the Star Wars edition. Let's see. Okay, so we.
Star Wars edition.
Yeah, well, we just started out with that.
Packers edition.
So as our company, just a little plug for our sponsor, hit 1,000 5-star reviews. That was big news.
Yeah.
That was awesome.
1,000 5-star reviews. That was pretty cool. Jess was instrumental in all that. And
Thanks, Jess.
the great service that our folks, that's what we're all about at Hall Financial is service. So that's just a sponsor plug. So let's move on to the news. Recap of where rates are, where they are, where you think they will be, thoughts about how the impeachment will or won't impact the Fed, current standpoint on rates. So interestingly, we started 2019 with this thought that rates were going to go up. And as the year went along, rates stayed steady, even descended a little bit. Turned into a big year for a lot of refinances for people that basically anybody that had bought a home that didn't refinance in the summer of 2016, rates were lower, right? Because that was the only period of time over the last 10 years that we saw lower rates than we did. So just in summary, it was a great year for the consumer, for mortgage interest rates, for purchasing homes. And here we are sort of turning the corner into 2020 with, as usual, more uncertainty about where rates will be, the president, the impeachment, everything else. But still remains a great time to purchase a home and potentially refinance. So the market is hot, and we're going to talk about some of the things that have been going on. But just from your guys' perspective, how do you guys sort of view 2019, especially Chris Henry from an origination perspective, how you guys sort of viewed it and how the consumer sort of thought about the year and where we head into next year?
Well, I think we continue to just, we talk about this pretty much weekly, but I think it's good that we talk about it when we do our podcasts is, clients see what the media gives them, right? And a lot of times rates are either a couple weeks behind what they're seeing. But the biggest thing that we'll continue to say is until we start to see the rates get into the mid 4s, high 4s, it's a great opportunity to refinance. Again, purchasing a house is always going to be a great opportunity, getting out of renting, and we'll talk more about that on one of our subjects later in the show. But refinancing right now, don't wait. You know, the only thing that's going to happen when you're waiting is you're waiting, then you finally decide to do it, and rates potentially are 0.25% higher or 0.25% lower. There's no reason to rate. If you think there's value in what you're doing, and again, you should have a mortgage loan expert help you out with that, whether or not you're saving a lot of interest. That's one thing we talk about right now is saving interest over the life of the loan. If you bought in 2019, let's say January, for $200,000 at 4.875%, and now you're looking to refinance, and let's say we can get you down to 3.875%, you're not going to see these huge savings in monthly. Like, the math doesn't work there. You're going to see monthly savings as far as how much you're writing that check for each month, but the biggest thing you want to look at is how much interest you're going to save over the next 3, 5, 7, 10 years, and we have calculators that can kind of help you do that.
Yeah,
For sure.
huge. Go ahead, Dan.
I was just going to say, I mean, I think a big thing just to touch base on that is urgency. I think, the market moves every single day, and you just never know when that big spike is going to happen. So you just definitely don't want to miss out. If it makes sense, do it. Take advantage of it when you can, because you never know when it's going to go away.
And I would
Which
even
could be soon.
Right, and I would even go on top of that. Like, let's say at the end of 2020, rates are back in like the 5% range.
Yeah.
If you're in a position where you need to consolidate credit card debt, you need to take money out for kids going to college, if you're looking to lower your term and you already have a higher interest rate, if you can get interest rate, and again, there are costs to do mortgages, but at the same time, we can show you how to offset some of those costs. A mortgage should be like, hey, if you can save a little money, yeah, you got to go through a now 14-day process opposed to potentially a 30 or 40-day process like it was in the past. But really, anytime you can lower your mortgage and not necessarily have to go back to a 30-year, because we have flex terms, I like to always talk about that, it's a great opportunity to continue down the path of getting your home paid off in the quickest and cheapest manner possible.
For sure.
One of the biggest things I think that has gone on in the business, and I call it the widespread market. And the reason I call it the widespread market is because people always want to know, where are rates? What are rates? That's the question you always get. And what's interesting about that is if you go back, for veterans like myself, you go back 20 years, you could kind of narrowly tell people to some degree where rates were.
Yep.
But today, I might talk to two separate people today. One guy or gal might be a first-time home buyer with maybe not great credit, doesn't want to put a lot down. We may lock them in around 4.5% or something like that to help them out with seller concessions and fees and other things. We might get on another call with somebody who's got great credit that wants a 10-year fix that wants to pay 2 points. They might get 2.875. I mean, you're talking about a wide spread in terms of, because you can do a lot of things now, whether it's a shorter term or a longer term or less down or more down or how much they want to pay in fees. There are ways that you can help the consumer to make it make sense for them. So a lot of times I'll tell people, well, I'll make it make sense for you. And they'll say, well, what does that mean? Because it sounds like that, maybe I'm trying to sell them something. That's not what I'm trying to do. I'm trying to accommodate their situation. And I just think that spread has a lot of consumers a little bit bewildered about how can that really happen. But I think when you get a chance to sit down with them, when you say it like kind of on a podcast, people are like, huh? But when you sit down with them for like 40 minutes and kind of explain to them how it works, they're like, wow, okay, that's cool. So you can help me in this way or that way depending on what my needs are. I think that's interesting that we could lock in people at, 1.5 points different in rate, and it could be good for their situation in either respect.
Yep.
Well, I like, David, you say you're not trying to sell them. I actually look at it a lot of times when we're talking to our clients is like we almost have to sell them into them kind of switching the switch. They're switching their switch to say, oh, yeah, that does make sense.
Yeah.
That's the sell to people. Mm-hmm. I'll give you an example. I bought a timeshare. This was a terrible, terrible purchase.
You bought a timeshare, Foz?
I bought a timeshare like
breaking
6
news
years ago.
Did you ever hear that ad, by the way?
I've been calling them.
Yeah.
Get
you out of that
me out of my timeshare.
Tell your story, then let's get into your timeshare. I did not know. It's just like you to have bought a timeshare.
So I bought a timeshare. Wow. Long story short, I walked into some store at the mall and it was like, here's $100 gift card if you sign up for this, right? And I have 2 kids, Olivia and Aiden, and they love water parks parks. So it was like you got like a free night stay and $100 gift card to go up to Boyne Mountain, Avalanche Bay. It's a nice water park, but you had to go.
A lot of germs in there, from what I hear.
Yeah,
Probably.
Okay.
You had to sit there, through the seminar for like an hour, and like I was like, no way anyone's going to sell me. Well, they sold me. Right, and they sold me, and they sold me good. And the reason they sold me
on
is
the
like,
timeshare.
On the timeshare,
Okay.
And I was like,
for the $100,
$100 is what I got. I bought the timeshare for like $15,000.
15,000.
Yeah.
Okay.
Wow.
This is getting good.
So
this is better than anything we had on the agenda.
Yeah.
So long story short, I continue to pay on my timeshare, and like the fees are like $400 a year when you start. Now they're $750. Right?
You still paying into this?
Not on the actual.
He still has the timeshare.
I have the timeshare. I already bought it outright, but I still have to pay $750 a year.
Until when?
Every year. That's
Forever?
Forever. Forever. That's how timeshares work, and that's why they're a
I'll get,
ripoff.
like,
Have you been to your timeshare recently?
So it's you get points. You go anywhere you
Yeah.
want, but it's a crock, right? Sorry for anyone that listens that's part of a timeshare company. Long story short, the guy sold me into why this was a good idea, and I really thought it was a good idea.
Of course, you paid 15 G's.
And if I traveled the way that they want you to travel on this, it would make a lot of sense. So the point to all of this is we're not selling people to like have them buy something that like sucks or isn't beneficial for you. We're selling you to make sure that you understand.
Right.
And I think one day, I don't know if it's a year from now, 5 years, somebody's going to call and someone's going to say, hey, Chris, I'd like a 10-year loan with $2,700 in costs and this and that and that. And that's how people are going to be more so not just
a la carte?
A la carte.
I don't know
Maybe.
about that.
I
It's
like
a little
it.
confusing.
You're totally right, though, about like.
When are we getting into this timeshare?
Yeah, we
Later?
do have to come back to
Okay.
that. But you made a great point, which is people. It is a mindset shift, kind of from what you said. Is the trained to say, what's your rate? I got to shop rates. I need to know what your rate is so I can compare A, B, C, and D. But it really boils down to getting well beyond that into what exactly is going on and why the 2.875 10-year versus the 4.5% 30-year and every single thing in between could possibly make sense. That's the challenge.
Well, and there's two big things. Well, it's just no different than if I always use my furniture store analogy. I don't know why I always use a furniture
Love
store,
the
but I
furniture
do.
You love furniture.
If I go to the furniture store, because I know nothing about what I'm doing, I walk in there, I'm just dying for somebody to close me. Just somebody come tell me what to do, because I'm lost right now. But if the guy comes up and says, hey, Hall, you can have all this stuff for like $50 a month for the next 3 years, or hey, Hall, you can give me $8,000 right now and take all this stuff. It's kind of the same thing. You know what I mean? It's what we do. We're like, hey, you can pay it over time longer and it's going to be a little cheaper, or you can pay it quicker and shorter, and then your credit has so much to do with it. I think that's the other key point that we have to really continue to hit home for people. I think one of the big values of the podcast is what are important things. I'm thinking about my future. I'm maybe thinking I'm going to buy a house one day. I'm a young person, whatever. Credit, and nobody talks about it enough because we all know, but a lot of people don't know, if you have 760 credit or higher, you're getting the very best of the best.
Yep.
If you're down around 660 or 650, you're barely qualifying and you're not getting the best of the best. And I think we need to talk about that more because more people need to know that they're wasting money if they're not being diligent with their credit.
Yeah. Do you did you opt for the $50 a month furniture route, by the way? Because
my wife makes all furniture decisions.
Yeah.
I've opted out on all furniture decisions. It's great. These
financing furniture sounds like a bad idea. to
Yeah,
me. It sounds
well-
like one step above the timeshare.
Well, I think in my younger days, when I was like trying to sort of get by a little bit more than you do when you get older, I
Right.
probably was financing the furniture. I would imagine today I'm probably paying for the
100%
furniture.
finance it. Why would you pay it up?
Henry's like, I got my
It's
hand up,
interest-free.
$50 a month right here.
Yeah, I suppose that's
0%
Yeah,
most of the time.
that's
Yeah.
true.
Just like that timeshare.
That is not 0%.
What happened? What in the
where-
world
where
happened?
is- where is your time?
Again, you get older.
You
don't-
are a level-headed guy. You are not. And I dare to call you cheap, although I would say frugal because it's a nicer word. But you're not the kind of guy to just go in and start throwing money around like that. So I am really
Yeah,
surprised.
but it's a deal though.
The sell is basically like, hey, you get to go here for 7 days, 6 nights or whatever it is. You don't pay anything, right? You're not paying anything, so you're paying for it in advance. And my timeshare allowed for me to do like 10 to 14 days, depending on where you go per year. And but it's limited as well. I mean, there's a lot of places you can go, but you can't just go anywhere.
So why would you
I'm
say
out.
it didn't work out? Because it sounds like that you could have. I mean, you could have gotten value for what you paid. You didn't like the choices of where to go. The accommodations weren't nice.
Yeah,
Like, what was it?
You know me, like when I want to do something, I just want to do it.
Yeah.
And so sometimes it's like, oh, I want to go to Miami this weekend. It's sold out, on through the timeshare, so you can't. Or
Gotcha.
So that's the reason
Well,
why.
because you have a specific week, right, that you pay for.
No,
Oh, you don't.
I get points.
You got flex time.
I get like points, and you use your
Got it.
points.
Was
for
your
wherever.
wife with you when you made this decision?
she had to be.
So you guys like did it together. So she couldn't say, "Hey, Chris, what'd you do this for?"
Well, Stace, she thinks all of my ideas are great, so she just agreed.
It's unbelievable. It really is kind of true, and it's one of the wonders of the world that Foz found somebody that thinks that everything he thinks is great.
That's good.
God bless her.
That's good to know.
Yep.
Sounds like you're not using it, so someone like Hank or I that might maybe
perfect.
need to jump in on this.
Can you
timeshare.
send an alternate?
Yeah.
Yeah.
Hank,
Oh,
get in
yeah.
on that. It's free.
Free.
You are Mr. Free.
Free is for me.
All right, VA loan changes. What do we got, Foz?
So VA came out and basically said that there's going to be some changes to their funding fee. So if you're not exempt from the funding fee as a veteran, which typically means you are exempt if you have some sort of disability with the VA. So again, shout out to all of our veterans. We appreciate everything you do for us. And then the VA basically says, hey, you don't have to pay this funding fee. So they have increased the funding fee for 2020, very small amounts, nothing crazy. But with that, they also have increased the changes to the entitlement. So now for some of our veterans that have larger homes, $500,000, $600,000, $700,000, there could have been some issues in the past where you weren't able to necessarily do a full VA loan, or you had to change how the loan worked. Now, more than likely, any VA loan up to a certain amount, again, getting into that $600,000-$700,000 range. Every state's going to be different when it comes to the entitlement, but it's kind of like, all right, we'll let you finance a little bit more money, but we're also going to take a little bit more from your funding fee as well.
Mm-hmm. Yeah. And they usually adjust the funding fee annually, right? This isn't like something.
The funding fee hasn't been adjusted in a few years.
Okay.
I can't remember the exact last time, but this is the first time since we've opened the doors, since at least 16, that it's really been changed. So we can double check those facts.
Okay,
Yeah.
good news.
All
I
right.
like it. All right, conforming loan changes. So every year around late November, early December, the conforming loan limit typically goes up a little bit in accordance with appreciation in homes. So, gosh, I want to say 20-some years ago that it was like, I remember, 190 or 210, 214.
Yeah, something rings a bell.
And now the conforming loan limit is $510,400, which is up from $484. So it went up about $25,000, which is good news for consumers for a couple of reasons. One, you guys can jump in with other reasons I'm missing, but one is a conforming loan, which is that amount or lower, is the easier one to qualify for versus jumbo. Usually you got a better chance of having no appraisal required, which speeds up your process. There are just a number of things that if you fall in that 510 or below bucket will help you. But that also, this whole nationwide high balance thing now is a part of that, which means you may not be in jumbo just because you're above 510. I don't know who wants to take that on and talk about that.
Well, first off, I think it's crazy to just think, back in 2016, 15, 16, the conforming limit was 417.
Yeah.
Yep.
And some change. And so in literally 4 years, we've went up
100 grand.
93,000.
Yeah.
Yeah,
Yeah.
exactly.
Yeah.
So that's just the economy is getting, I would, some of that would be to the economy being better, but housing values are going up, allowing more people to do it. What David's talking about is our high balance nationwide loan, which now anything from 510, 400 up to almost $700,000, that allows you to have conforming underwriting and conforming pricing, even though at most institutions that is considered a jumbo loan, which makes us really, really competitive now.
Yep.
So, and that's in certain counties.
High balance nationwide is no
across the
certain
board.
county, anywhere possible.
It's typically in certain counties, but we've got
The
the
hookup.
all access pass.
Yeah.
Which is nice.
Which is very
So
nice.
basically, at Hall Financial, our conforming loan limit is about $700,000.
You could sell.
You could say
somewhere like
that. Yeah.
Yeah.
Yeah, it's 5% up to 35, and then
That's right.
10% up to 700.
That's right.
Conforming loan.
Right.
Exactly.
Yeah. So 5. So some of the news that came out of this, just when you do the math on the whole thing, is you can now buy a house with 5% down if it costs $535 or below. So
Yeah.
if you find a house that's $500,000 or lower, you can do 5% down. Generally
amazing.
speaking, as long as you, qualify. Yeah, it really is amazing.
And to go with the high balance, you can buy a $760,000 house with 10% down, no PMI.
No PMI. Yeah.
pretty
cool.
good. Yeah.
That's
So,
unbelievable.
Yeah, very good options.
and then FHA also had some loan limit changes where that also went up. So basically, we saw, FHA kind of follows suit with the conforming loan limit, with the appreciation of homes. You got a higher opportunity to refinance, which is good news for a lot of people that potentially either wherever they bought, because it also comes into play with their refinance as well. And I don't know how much you guys have seen that with people taking advantage of these higher loan limits, but I've got to imagine that that's a big thing for people that were right at or maybe just over the threshold who want to take advantage of those new numbers.
Well,
On either option, on either conventional or FHA.
Sure.
Yeah,
Yeah.
you're exactly right.
And one of the things that you said earlier, D-Hall, was, if your credit score, right? Credit, we need to if your credit score is 650, 660, that's not great. We were talking primarily for conventional loans. If you have an FHA 640 credit score now, you can buy a house for $344,000 with 3.5% down, and we're getting clients with these 640 credit scores in the mid to low 3% right now. That's how good FHA
Yeah,
pricing is.
that's a great option. And you think about that too. I mean, FHA's always sort of been like, a little bit of the little brother kind of, right, to conventional loans. Bruised credit, lighter on the bankruptcy or other guidelines like that. But now you're talking about, a $330,000 home, 3.5% down, and a rate in the mid threes.
Yeah.
I mean, that's nuts.
Yeah,
It's
it is.
awesome.
Yeah.
And
It's
with
great.
and the pullback a lot is, well, what's the downside, right? So the downside is, well, you have to pay PMI.
Pay mortgage insurance.
I wouldn't say that's a downside, because how many people, even on a conventional loan these
Right.
days,
Are paying the
are
same
paying
amount.
the
paying it
PMI.
as well.
Yep.
Right.
So
Yep.
better credit, cheaper PMI on a conventional loan.
Yep.
FHA doesn't matter where your credit is; you're paying the same amount of PMI.
Yeah, well, sometimes you're in like the between credit score too, like
Right.
the 700, and sometimes your debt to income might not be qualifying for conventional, and FHA might be a better deal for you.
Got to
You
look
just-
at all
you
options.
just gotta look at all options.
And that's one of the things about our business that's interesting is, and I think it's true with any profession, but, in our business in particular, you get a first-time buyer or even a second or third-time buyer. They're really reliant on somebody like us to make sure that they know all their options. And a lot of times in our business, there are a lot of people out there that don't know all the options. They know what they sell. They sell this. They don't do FHA loans. They don't do that much conforming. And that's the case. So when you're, in my opinion, one of the good questions to ask if you're thinking about buying a home or you get introduced to a mortgage loan officer or a company is like, do you do conforming and FHA? Because a lot of people will tell you no on one or the other. We don't do FHA. We only do conforming. Well, that's a problem because you want to have all your options. You don't want to have what they're selling. You want to have what's available in the market, which I think is a very important thing.
Or the individual maybe does one or the other.
Correct.
So that
Yeah.
I don't really know that much about FHA.
Correct.
You have to talk.
Well,
to,
that's more of what I'm even talking about.
have
But
to
you're
talk
right.
to
The
Jim
company
over here.
and the
Right.
individual.
Yeah.
Right. Exactly. Okay. Rent going up. Interestingly, we talk a little bit on the show, but not a lot about rent. And one of the reasons that I just have a bias towards not really. I think renting versus owning is completely situational. I don't think one is better than the other. I've never been a guy that proponent like, hey, nobody should be renting. You're throwing your money away. I mean, there are situations where renting makes more sense depending on how long you're going to live there. If you're transient, you're not going to be in this town a long time. How much money do you have to put down? What your credit look like? I mean, there's a lot of situations where renting is better. However, as rent continues to increase year over year, and continues to go up. You look at an affordability kind of a thing, and we have a lot of clients that do that who go out and say, "Hey, I was looking around, and I could buy this house for $270,000, or I could rent this place for $1,600 a month. And you start doing the math to figure all that out. It's like, where am I getting more for my money? And I think that that's something that people are going to continue to go through. And I think that obviously there's advantages to home ownership financially as it relates to tax deductions, appreciation that you get in the property. But there are also there's reality situation of things going wrong with the home that you need to fix. So that's just an analysis that just always has to be done. I think in the long run, what you see with, most families or a lot of people that are established, they want to own a home because they know it's a good investment. But that's not always the answer for everybody. I think it's important we talk about that. But in general, when we've done this analysis for people, generally speaking, owning a home usually makes more financial sense than renting. I don't know if you guys have seen situations recently or have comments about maybe an example of that, but I just think it's important that we talk about that in a balanced way with our listeners.
Yeah, I mean, the biggest thing that I see with people that want to buy a house that are currently renting, I don't know if it's even necessarily about which one is better for them. They believe that they don't want to give money to their landlord. Right. I see a lot of loan officers on social media. Like, there's a guy I follow on LinkedIn that basically says, like, landlord 0, client 1, because he's like taking people out of rent and putting them into mortgages. With all of that being said, the biggest issue with a lot of people is, one, they either don't have enough money. Well, there's solutions for that, right? For USDA, getting the seller to pay some of your closing costs, or number 2, credit. And we've talked, it seems like we're talking more and more on this show today about credit. It's like you have to be able to get into that 600 range for you to feel really good, more than likely, about being approved for.
What do you mean 600 range?
It's like 600 credit score.
Well, that's kind of like the ante, at least.
It's like the low water mark.
At least to get into the conversation.
That's what I'm saying.
Right.
If you make a lot of money and you have a lot of money in the bank, but maybe you just weren't very good with your credit while you were in college, and you're in a 490. Unfortunately, there's no options for you.
Right.
That's right.
We should maybe have a credit discussion. Because we talk about credit as sort of this big general kind of thing out there, like you need good credit. And I think people associate that with, I make my payments on time. But what about that stupid medical thing that you never dealt with for $50 that's sitting out there? That thing will absolutely bring you down.
Yeah.
If you don't address it. So, but that's a whole nother discussion.
Yeah, we could do a whole. Maybe that's our next show, Jess.
Maybe.
Credit show.
Maybe.
We could do it.
I love it.
Henry can come up with some examples. We could have some cue cards.
Cue cards.
Yeah.
Yeah.
Like
We
that
should pull
right
up
there.
Henry's credit report and dissect it right here.
I bet
into
it's as good as it gets.
Pretty good.
Yeah.
It's not bad.
Gotta imagine.
It's not bad.
Because Henry will do whatever he has to do to pay less for whatever that thing
Less
is.
is always better.
Less is better.
Less is always better.
Okay, I like this subject. Did we get this right off the wire, Jess?
We did.
The silver tsunami is coming.
Wow.
Yes, it was actually over Housing Wire,
The silver tsunami.
the MPA, so mortgage, whatever.
Professional Association.
Professional.
Between now and 2030, experts are projecting that the wave of boomers moving into retirement is going to hit, which will allow roughly 20 million homes to hit the market. Areas that will reap the most benefit: Miami, Orlando, Tampa,
Tucson is that word.
and Tucson. Okay. Well, I got confused here because it was Miami, Orlando, and Tampa, Florida,
Oh.
and Tucson, Arizona. So
Gotcha.
a lot of homes going to be coming on the market as these boomers go ahead and move into retirement. And I guess that kind of plays into something that's just been in the news a lot lately over the last couple of months, is this housing shortage that continues to be an issue, right? So you want to have this Goldilocks market that's just right. But what we've found over the last, I'd say couple of years is part of the reason it's been a little bit more of a seller's market in general, is just because there's not tons of inventory available for all the buyers that have come out. But it sounds like, at least according to this article, in the months or years to come, there's more inventory that's going to be coming into the market due to demographics, life situations, things of that nature. So
I've always found it weird. How do they find out this info?
well, yeah, it's a whole statistical kind of a data dump sort of a thing,
Yeah.
right?
Crazy.
It must be right, because the amount of senior citizen living centers,
Unreal.
it is
Everywhere.
incredible.
Well, they built a whole city in Florida called the Villages.
there's
that's
that.
it's a city.
Yeah,
They
but
built a city.
where I live, there are like 3 or 4 new, just huge metropolises that are these senior living centers.
Yeah.
I mean, and one isn't even done, and the next one is like 2 blocks away and starting.
Yeah.
It's unbelievable. This must be true.
And they're making them like cool. You know what I mean?
Must be
Yeah.
accurate.
Like,
Cooler.
yeah.
They have swimming. Like,
Absolutely.
It's like now, like at 60, you might, we think of, at least what I do, when I
Yeah.
think of a living center, I think like 75, 80, like when you can't do anything by yourself or potentially.
Right.
These are starting to be set up for, it's just like, hey, it's like a frat party again.
Right.
It's like the life stage, right? It's like you get to a certain end and then it starts going,
The
right?
CMU frat.
Like your
party.
kid, right? Macklin. He's pooping all the time now,
Yeah,
right?
that's what he does.
And now, like, potentially when your dad gets older, that happens again as well.
Correct.
Right? That's the cycle of life.
Well, there's this old saying that, before 10 and after 80, you're sort of in the same boat, but I mean, I don't know if that's exactly true, but you sort of can say and do whatever you want when you're, before 8 years old and after 85 years old, and nobody cares because it's like,
Right.
it's okay.
Well,
But
so this says there's going to be a lot of houses
a lot of houses coming to the market.
because all the boomers. Are you a boomer?
No.
Oh, okay. Well, I
What,
just
you
wanted to be
crazy?
sure.
You and
Well,
I are
know.
the same age.
Yeah, you're a little
I love
older.
it when he does this.
You're a little
Birthday week for you this week, big guy.
yeah, a couple
Huh?
days.
Yeah, how about that?
Yeah.
When's your
Well,
birthday?
He's the day after Christmas. We're doing this podcast for Christmas week, and
Mm-hmm.
Mr. Pizzoli is he's getting inching near that 5-0. Inching.
long way to go.
No. A year or two to go
All right,
is
well,
all you
cut.
got. That's it. Henry, any parting words today from Live on Real Estate for the audience about anything that's going on in the market?
Just happy holidays to all of our listeners,
Yeah.
all of our past clients, all of our current clients. Enjoy the time with your family,
Yeah.
and we'll see you next year.
Yeah. Mr.
Yeah.
Pizzoli?
No, well said. Can't improve on that.
Okay. Fosta?
Yeah, I mean, it's been a long run since we've opened the doors almost 4 years ago now. So we're learning every day, and we're helping more and more clients every single day. So thankful to all of them, all of our partners, everybody. The mortgage industry, I think we say this every week, isn't easy, right? Phil likes to say that. So it takes a lot of people to get a loan from start to finish. And one last thing, go Pack, go.
Oh, yeah. Okay. Well, hey, they're kind of the up and down story. I think that the most interesting thing that's going on in the market has to do with where are rates headed in an election year in 2020. A lot of folks are predicting that we still have a great market in 2020, similar to 2019, which is good for the consumer to be able to take advantage of. So if you haven't refinanced or looked into it, you probably want to do that, because I don't know if we have more than a 6-8 month run, if that. It could be any day. You don't know what. I mean, we get news every day that can impact mortgage interest rates. So something happening overseas, an impeachment, anything like that can really impact what you can do with your mortgage. So just as a public service, look into refinancing if you haven't done that yet. And then the other thing is, for home buying, it's a great time for people to buy a home because of what's gone on with interest rates. A lot of people say that a lot of big corporate profits have been fueled by the fact that Fed has kept money cheap. It's kind of the same thing with housing in terms of where interest rates are, keeping your ability to buy a nice house cheaply because of the fact that rates continue to cooperate. So I think that those are both good news stories for the consumer. And then I think that the other big story that you just have to think through as it relates to what's going to happen in the future is if you own a home, it's also a really good time to sell a home because of the fact that it's been a seller's market, rates are low. So very, very, I wouldn't say infrequently, but not as frequently as we would like, do we get this kind of a market that we're in right now where it's really good for sellers and it's really good for buyers. Usually it's like, it's a real seller's market, or gosh, there's nothing, there's such a buyer's market and they have their pick of the litter. Right now it's really kind of in that balanced stage, which feels good. And if you live in Michigan, where we do the majority of our business, the winter time is a great time to go out and look for a home before that April, May, June time hits, where everybody's competing for the same home. So,
yeah. There's one more bucket that goes in there too,
Yeah.
which is if you've been looking for a home, there isn't been a ton of inventory. Maybe you haven't found what you're looking for. You may decide you're going to keep your own home and spruce it up and do
Yep.
some home improvements
Right.
and take some cash out, and then rates are really, really good for that too.
Yeah.
So
yeah. And if you basically, in the last 10 years, if you bought a home, you've seen appreciation.
And you've seen
which is
appreciation,
nice.
so you've got more equity.
You've got
Yeah.
opportunity to
So,
do that if you
yep.
think about doing that smartly. Okay, guys, great show. Another one in the book. Jess, thank you.
Thanks, Jess.
Happy
Thanks, Jess.
holidays to everybody. This is our holiday week show, the end of 2019. We'll see you again in 2020. This is Live on Real Estate.